Hello everyone, welcome to the 170th episode of me learning how to trade in Forex. So in the last episode we were going through what is fundamental analysis. So fundamental analysis is based on the notion that every asset has a real fair value. However, at certain times the market may not necessarily reflect the asset's true value. So this results in the price being either higher or lower than it really should be. So fundamental analysts then believe that the price will tend to naturally correct over time, gravitating towards its real fair value. So in fundamental analysis, your aim as a trader is to discover assets that are currently underpriced or overpriced, then place trades to capitalize on their potential movements as their value corrects. So how does this differ from technical analysis? When you conduct technical analysis, you focus exclusively on price data and movements, seeking trends and patterns that indicate the likely future direction of a market. In fundamental analysis, however, you take a more holistic view, so overall view, and consider all the circumstances surrounding the markets. So you might evaluate the general health and well-being of the entire economy, industries within that economy, and individual companies that make up an industry. So this could include assessing all kinds of factors, so from a whole country's employment rate or manufacturing output, companies' cash flow and expenditure, etc. Fundamental analysis is often said to be more rigorous and comprehensive than technical analysis because everything that can affect the asset's values is studied and taken into consideration, not just the price data and chart patterns. And then we went through the lesson summary, and then we went through, so how does fundamental analysis work? So rather than having one prescribed universal method, fundamental analysis can be conducted in a number of ways, but many analysts tend to use a top-down approach, so looking at the bigger picture and then drilling down into the details. So looking at the whole economy as a whole, and then looking at different sectors within that economy, and then looking at different companies within the sectors. So we then looked at some steps on how to analyze the market for potential opportunities using fundamental analysis. So consider the overall economic performance. We could do that by looking at the macroeconomic data such as the GDP figures, manufacturing output, CPI or consumer price index, retail sales, house price indices or employment statistics. Also include or consider news coverage and political rhetoric. And then we look at which factors will be affected. So how will macroeconomic factors influence different types of business? So when the economy is expanding as a whole, certain industries may benefit more than others, and there can also be times when economic expansion has a universally beneficial effect that is felt by most sectors and companies. So in this case, then it might be worth considering a strategy geared towards growth. So looking into sectors which could be rapidly expand, or which could have high potential for rapid expansion when the conditions are favorable. So on the other hand, if the economy is expected to shrink, you might decide on a more conservative approach, so investing in stable companies that are geared towards income. So these would be like energy or utility stocks. And then we could aim to capitalize in the market falling, so by going short on them. And then we went through select a sector to focus on, so which sector has the greatest potential. So consider supply and demand levels for the products and all services in each, and how other factors affecting their future prospects. So look at the size of the market, its overall growth rate, and the sector's significance in the economy as a whole. So in the stock market, it's typical to see particular groups of shares moving together in the same direction. So for that reason, it can be more important to choose the right industry to trade on rather than simply the right company share. That's where we left off at. So we've got this one last section to go, which is to narrow it down. So narrow it down. Which companies merit further analysis? Which companies benefit from further analysis. Merit or deserve further analysis. Now that you've decided to focus on a particular industry, the next task is to take a closer take a closer look at its constituent companies and decide which ones to explore more in depth. Take a closer look. So after deciding to focus on a particular industry, take a closer look at its constituents companies and decide which ones to explore in more depth. At this point, it's important to take stock of the competitive landscape within the sector. Take stock of the competitive landscape within the sector and any anticipated future business trends. Take note of competitive landscape within the sector. Competitive landscape within the sector and any anticipated future business trends and any anticipated future business trends. Here are some quick questions that may help, or here are some questions that may help. Ask the following questions. Which companies have the largest shares of the market? Which companies have the largest share of the market? Who is a recognized market leader? Who's a recognized market leader? Okay, I can't spell. Who is a recognized market leader? Are there any new and disruptive players in the markets? Are there any new and disruptive players in the market? Are there any imminent changes or developments that might shake up the hierarchy in an industry? Are there any imminent changes or developments that might shake up the hierarchy in industry? Are there any imminent changes that might changes or developments that might shake up the hierarchy in the industry? The hierarchy in the industry. Imminent. Will any current competitive advantages soon be under threat? Will any current competitive advantages soon be under threat? By thoroughly analysing the business environment, you should be able to see which companies have an edge over their rivals. These are likely to be the ones worth investing in, and we'll explain how to delve further into their prospects in the next lesson. You should be able to see which companies have an edge over their opponents, their rivals. These are likely to be the ones worth investing in, and we'll explain how to delve further into their prospects in the next lesson. It's worth noting that when you conduct fundamental analysis like this, you should always be comparing apples with apples at each stage. In other words, when looking at a country's economy, you compare it with other countries' economies. When assessing industry sectors, you view them alongside other sectors. And when you come to individual companies, you contrast them with other companies in the same sector. For example, if you're looking at Barclays, you compare it with another bank such as HSBC and not a retailer like Tesco. You should always be comparing apples with apples in each stage, at each stage. So always compare in the same context, I want to say. So that's a summary. Fundamental analysts generally use a top-down approach. First, they consider the overall economic picture, then they assess the performance of different sectors and select one to focus on. Finally, they look at companies within the sector to identify those with potential. Yep. So, next lesson, analysing an individual company. Individual 18th. Having studied the wider context in which a company operates, your next step is to examine the business itself. When you're performing fundamental analysis on an individual company, it's advisable to take into account a number of qualitative factors. Let's look at them in detail. So, when performing fundamental analysis on an individual company, take into account qualitative factors. So not quantitative, which is many factors, but qualitative. So let's have a look at them in detail. The business model. First, it's important to ask, how does a company make its money? So how does a company make its money? How does the company make its money? This seemingly straightforward question can be surprisingly hard to answer in some cases. Although many companies do have a very simple proposition at their heart, such as selling groceries or clothing, others may have complex or unconventional business models that take time to understand. For example, there are many niche technology companies that supply hardware or software to fulfill a very specific purpose. Their markets may be unfamiliar territory for you, unless you're actually involved in selling or using the product concerned. Key partners, key resources, key activities, value proposition, customer relationships, customer segments, channels, revenue streams, cost structure. Right? Can you explain the company's business model? Can you explain the company's business model? There are many notable traders who follow a rule of thumb. If they don't fully understand the product made by a company, the methods used to sell it, or the market that buys it, they simply won't trade on the share. Test yourself by explaining the company's business model to a friend in the simplest possible terms. If you struggle to do this, you probably haven't got the full measure of it yet. Can you explain the company's business model? Competitive advantage. A company will normally have competitors, and even if it's offering something completely new and unique, the chances are that imitators will soon enter the market. What gives this company an advantage over its rivals? This company an advantage over its rivals. You might want to consider, does this company offer something that competitors don't/can't? Or does it offer the same thing but in a more efficient or effective way? Once the company has firmly established its competitive advantage, perhaps by becoming a household name brand or having a product that dominates the market, its position may seem unassailable. In these conditions, the company can often flourish and maintain profitability for a sustained period, and as an investor, you can reap the benefits. But don't get complacent. All good things usually come to an end eventually. So, consider if the company offers something that its competitors can't/won't, and or does it offer the same thing but in a more efficient or effective way? So, while a company has firmly established its competitive advantage, perhaps by becoming a household name brand or having a product that dominates the market, its position may seem unassailable. In these conditions, the company can often flourish and maintain profitability for a sustained period. And as an investor, you can reap the benefits. But don't get complacent, all good things usually come to an end eventually. Did you know when the FTSE 100 reached its 30-year anniversary, January 2014, only 30 of the original constituent companies were still members of the index? The other 70, despite having been the industry leading titans of 1984, had either gone bust, been taken over, or simply slipped into obscurity, to be replaced by new contenders in the top 100. Can the company maintain its advantage? Can the company maintain its advantage? A successful company will generally need to evolve to stay ahead of the competition. If it appears to be resting on its laurels or running out of new ideas, these are warning signs that trouble could be imminent. So, a successful company will generally need to evolve to stay ahead of the competition. If it appears to be resting on its laurels or running out of new ideas, these are warning signs that trouble could be imminent. HMV, store closing. Take the example of HMV. In this case, a leading high street retailer struggled to adapt as the marketplace changed, with consumers increasingly downloading or streaming music rather than making physical purchases. HMV's core business was eroded. Apparently lacking a backup plan, the company was destined for terminal decline. Much like Blockbuster as well. They used to sell CDs, I think. But because everything's gone streaming online, nobody buys the physical CDs anymore, so yeah. It's gone bust, I think. So lesson summary. When evaluating an individual company, it's important to understand its business model. Consider the competitive landscape and compare the company to others that might threaten its position. Compare the company to others that might threaten its position. Ask whether the company has the capacity to evolve successfully in a changing environment. Cool. Evaluating company's management. Evaluating a company's So 18th. Technically, a company is a legal entity that exists independently from its staff, but nevertheless the people that run the company, their skills and personalities, plays a huge role in its success or failure. Many analysts believe the management team is the single most important factor affecting a company's prospects. The people that run the company with their skills and personalities play a huge role in its success or failure. So your next step is to find out who is currently leading the company and assess whether it's in good hands. Vet the executive team. Fortunately, the internet usually yields plenty of information about the people at the helm of a company. Here are some questions it should be able to answer. So, vet the executive team. What is the educational background of each executive? What is the educational background of each executive? Where have they worked previously? What relevant experience do they bring to their role? Experience do they bring to their role? Have they had any notable achievements or failures previously? Have they had any notable achievements or failures previously? From this, you should build up a picture of the team's key strengths, weaknesses, and general capabilities. You can then build a picture of the team's key strengths, weaknesses, and general capabilities. Quiz the management. You can also find out more about the company directly from its senior management team. One of the best ways to do this is through conference calls, which are usually held following the release of quarterly or full-year financial results. Investors and analysts can dial in and typically hear the Chief Executive Officer and or the Chief Financial Officer talking through the latest figures and explaining the company's performance. This is followed by a question and answer session in which the callers can raise any concerns or probe for more information about how the company is doing. You can normally find an archive of transcripts or recordings of these calls, along with all the company's recent financial results in the Investors Relations area of the company's corporate website. So, quiz the management. Find out more about the company through its senior management team by using conference calls, which are usually held following the release of quarterly or full year financial results. Investors and analysts can dial in and typically hear the Chief Executive Officer and or the Chief Financial Officer talking through the latest figures and explaining the company's performance. This is followed by a question and answer session in which the callers can raise any concerns or probe for more information about how the company is doing. So you can normally find an archive of transcripts or recordings of these calls along with the company's recent financial results in the investor relations area of the company's corporate website. Gauge management confidence. If anyone should know how a company is really doing, it's the management team. So the level of confidence these individuals demonstrate in the business can be very revealing. Naturally, their public statements will tend to be framed in positive terms, but is this reflected in their behavior behind the scenes? Specifically, are they increasing or reducing their stakes in the company? Senior executives are typically remunerated, at least in part, with stocks and options. This incentivizes them to make decisions that benefit the business, since their own personal wealth depends on its growth and success. However, when management are seen to be selling their stocks options, this may indicate a lack of confidence in the company or a negative view of its future prospects. Remunerated, at least in part, with stocks and options. Are the management team increasing or reducing their stakes in the company? Senior executives are typically remunerated with stocks and options, as this incentivizes them to make decisions that benefit the business, since their personal wealth depends on its growth and success. When management teams are seen to be selling their stocks or options, this may indicate a lack of confidence in the company or a negative view of its future prospects. How can you see whether the senior management team is actually selling their stocks or options. Like, how do you check for that? Is there a way to see what current stock and options they currently hold, or don't know. Gonna need to find that out. So look at management history. Look at management history. A strong business steered by a group of skilled individuals can still founder if those people fail to work together properly as a team, or if the organisation doesn't provide the right environment for them to flourish. If a series of senior executives have left in quick succession, for example, this could point to weakness in the company's culture or troubled relationships in the management team. Similarly, you might see a senior post being filled several times within a short period. When a management issue appears to exist, it's often wise for investors to steer clear of the company, no matter how good the underlying business model seems to be. So strong business can still fail even when managed by skilled individuals if those people fail to work together properly as a team, or if the organisation doesn't provide the right environment for them to flourish, or if the organisation doesn't provide them the right environment for them to flourish. If a series of senior executives have left in quick succession, for example, this could point to weakness in the company's culture or troubled relationships in the management team. So if a series of senior executives have left in quick succession, this could show weakness in the company's culture or troubled relationships in the management team. Similarly, you might see a senior post being filled several times within a short period. The senior post could also be filled several times within a short period, which also shows this. When a management issue appears to exist, it's often wise for investors to steer clear of the company. When a management issue appears to exist, it's often wise for investors to steer clear of the company, no matter how strong, how good the underlying business model seems to be. Review corporate governance. Every company will have a corporate governance policy defining the relationship between management, directors and stakeholders. Management, directors and stakeholders. What's the difference between management and directors? It's there as a safeguard to make sure the proper procedures are followed and to help prevent improprieties. So it's worth taking a critical look at it. Every company will have corporate governance policy defining the relationship between management, directors, and stakeholders. So every company will have a corporate governance policy defining the relationship between management, directors, and stakeholders. Defining the relationship between management, directors, and stakeholders. It's there as a safeguard to make sure the proper procedures are followed and to help prevent improprieties. So it's worth taking a critical look at it. So it's there as a safeguard to ensure the proper procedures are followed and to help prevent improprieties. And to help prevent improprieties. So it's worth taking a critical look at. it. It's important to take a look at it. It's likely to include the information on the board of directors. A good board will include directors who are company employees alongside others who are completely external and therefore independent. This structure is generally thought to protect the interest of shareholders, since an external director might, for example, feel less reticent about criticizing another member of the management team. So less, I'm assuming that word is going to be like reluctant. Yeah, so reluctant. So feel less reluctant about criticizing another member of the management team. So it's likely to include information on the board of directors, So a good board of directors will include directors who are company employees, will include directors who are company employees alongside others who are completely external and therefore independent. This structure is thought to protect the interests of stakeholders, as an external director might feel less reluctant to criticize another member of the board. Or management team. Stakeholder rights. People with an interest in the business, particularly stakeholders, should have access to the board and a clear route to raise any queries or grievances and get them addressed. So, people with interest in the business should have access to the board and a clear route to raise any questions or grievances and get them addressed. Takeover defenses. Companies will typically have measures in place making it difficult for rapid and perhaps unwarranted changes in the company's management. Directors or ownership to occur. As an investor, this can give you a degree of confidence in the stability of the business. So, companies will typically have measures in place making it difficult for rapid changes in the company's management, directors or ownership to occur. This can give investors a degree of confidence in the stability of the business. This can give investors a degree of confidence in the stability of the business. So let's say summary. Remember that the quality of the management team is a key factor affecting a company's prospects. Consider the strengths, weaknesses, and experience of each executive. Take the opportunity to question management using facilities such as conference calls. Check whether executives are increasing or reducing their shares in the business, or whether there have been any abrupt changes in the leadership team. Review the corporate governance policy. Cool. I'm going to leave this episode here then. In the next video, we're going to go through understanding balance sheets. So, thank you all for watching. Bye bye.